You won't believe what just happened to the housing market. You see, the housing market crash has already started, and now I found some new shocking data that shows the housing crash is going to be much like 2008 or even worse.
What? Oh no!
Home sales are collapsing, home builders' contracts are being cancelled, and existing new home sale contracts are also being cancelled. So if you've been dreaming about owning a home, or if you're someone that has been thinking about investing in real estate, well then I have some great news for you. Because in the future, homes are about to become much cheaper, and towards the end of the video, I'll cover which cities are about to experience the most pain from the impending housing crisis, with housing prices coming down 30 to 50% in just one city. So with that being said, let's not waste any time, let's get started. So to know if it is likely or not that a major crash in the housing market bigger than 2008 could happen, we need to understand the drivers that are going to cause the 30 to 50% price falls. First, we have the banking sector and credit loans. Because for essentially everyone, buying a home is the biggest financial commitment they will ever make. We all need a place to live, and most of us can't wait until retirement to accumulate the necessary funds to buy a house. So in order to address this issue, we borrow money from a bank to help with the shortfall in cash and repay it over time. And we are now moving towards a stage of the cycle where central banks are tightening monetary policy out of the concern for unchecked inflation. As a result of that, most banks are increasingly cautious about their balance sheet and the possibility of bad loans on their books, and even more so about taking on a new loan that may end up being risky in the face of growing prices. Now, here's a chart that displays the home price to median household income in the US since 1955. The price for a home in relation to income is even worse than the financial crisis of the late 2000s. And if we go back even further, other studies have shown that it's even worse than the Great Depression. Yikes! So house price to median household income ratio in the United States has far surpassed the 2006 housing bubble peak. This is one of the prime indicators that prices are too high and a bubble in the US real estate market has already formed. And at the same time, mortgage payments for medium new homes as percentage of median household income has also sharply increased over the last few months. This makes it harder to afford a house in the US for the average person. Not only that, but the fact that huge investors are also entering the market is one of the main reasons why home prices have been rising throughout 2021, because in 2021, investors bought a record number of properties. For example, in the major metro regions of America, investors bought approximately 1 out of every 7 properties sold in 2017. And it seems that the last half of 2022 and 2023 will be much worse.
According to data from the real estate research firm CoreLogic, nearly 1 of every 3 homes sold here in North Texas is being bought by an investor. And in many neighborhoods, I-Team reporter Brian New discovered investor activity is even higher.
In the past 18 months here in the Stop 6 neighborhood in East Fort Worth, investor buyers have bought more than 50% of all homes sold. To put that into context, in a typical housing market, investor buyers account for 10 to 15% of home sales. And in many cases, investors, when they've made these purchases, they have torn down the old home, replacing it with a new one like this. And it's not just happening in this neighborhood. When we analyzed the real estate data from CoreLogic, we found in these 21 North Texas zip codes last year, investor buyers accounted for more than half of all home sales. When we zoom into this map, you'll see 3 of the top 5 targeted zip codes for investors were just outside downtown Fort Worth. What made these neighborhoods attractive to investors was the price. When investor activity picked up last year, according to data from Realtor.com, the average listed price of a home in these 21 zip codes was under $250,000. Since then, home values have soared in these areas. So has rent, as well as property taxes.
You see, a Goldman Sachs-backed company recently announced the acquisition of an entire Florida community of single-family homes. And there are approximately 87 properties totaling $45 million. And now that the benchmark rate for a 30-year fixed mortgage is now at 7%, it's gonna be much harder for the average person to own a home. So naturally, interest rate hikes change the bank's pre-approval process, and increases in interest rates inevitably affect the bank's pre-approval process. Loan amounts authorized for individuals will also decrease. Some people will be completely priced out of the market, and potential buyers who narrowly pre-qualified at 3% interest rates may no longer be eligible at higher rates. And this brings me to investors starting to dump their real estate purchases that they have made in 2020 and 2021, because big data analysis has recently been employed by Wall Street-backed companies like Intera to assist rental companies in making smart real estate investments. Hedge funds bundle these transactions into a security that investors may buy. This graph also displays the recent upward trend in house rental acquisitions on Wall Street. You see, large banks like Goldman Sachs and JP Morgan provide financing to these rental businesses. Rental companies will have to put part of their rental housing units up for sale whenever these banks become hesitant about extending loans at higher rates in an atmosphere where housing speculation is on the rise. And as we start to see more and more interest rate hikes, this also brings massive recession fears. You see, right now, about 91% of CEOs expect an upcoming recession. And this number comes from a survey conducted by the Conference Board. Their primary concern is the Federal Reserve continuing to raise interest rates during a slow economic growth. So it seems likely that increased unemployment numbers are imminent. With income already stretched, people will have to downsize to apartments, and the migration to rental properties took place during the 2008 housing crisis. And as of now, the number of homes sold in the United States is declining. And note how this year's peak is way below the peaks of previous years. Also, many markets saw massive price increases during the pandemic that were simply not sustainable as interest rates started to increase. And so far, there are no signs of the trend stopping. The curve still continues to go downward, and as a result, home prices, which had been skyrocketing up until then, are starting to fall. So since we have more home sellers dropping their asking prices as rising mortgage interest rates and inflation ease up competition in the market, and we also saw massive price increases during the pandemic that were simply not sustainable as interest rates went up, we're starting to see some major home prices in cities starting to fall. For example, we have Boise, Idaho being one of those cities, as it has 61% of sellers dropping their asking price, according to a report from Redfin. Boise was one of the most popular pandemic markets as thousands of people went there, fled more expensive markets like San Francisco and Los Angeles due to the work-from-home lifestyle, and massive price hikes in several of these markets during the pandemic were simply unsustainable as interest rates increased. You see, the 30-year fixed mortgage average rate has nearly doubled since the start of the year, and because of this, the cost of ownership is a lot higher now. Las Vegas, Nevada is another example where we're seeing home prices in the city down 3% in August from the month before, and about 26% fewer homes sold within 2 weeks than a year earlier. We also have the San Jose, California area, where according to Redfin's report, the housing market has already cooled off because the Fed's rate hikes and rising mortgage rates have made it more difficult to afford a home. Another city is Fort Myers, Florida, because after Hurricane Ian, many people there are limited by low or fixed incomes. The state's increase in popularity, inflation, and soaring rental costs have also made it one of the least affordable places to live in the nation. There are approximately 2.24 million households in Florida with incomes below $50,000, and they also pay more than 30% of their income in rent or mortgage. More than a quarter of the total households, according to the University of Florida's Center for Housing Studies. Rental prices have also increased by more than 30% over the last 2 years. There's also going to be a decrease in housing inventory as homeowners pull their listing back to address damages sustained by the Hurricane Ian before putting them back on the market. And without a doubt, we could even see 50% price drops in some parts of the nation as the Fed decides to raise interest rates even higher this year. Now, this is not financial advice, but I believe that prices will be significantly lower in the next few months. Rents are already increasing as there is a big amount of people that cannot afford to buy a house. Some people also have to sell their house because of financial difficulties, and the number of people facing financial troubles will only increase as the Fed raises interest rates to try and fight inflation. And yes, we are already in a recession, but this could turn into a major depression unless the Fed decides to pivot their policies sometime in the near future. But I want you guys to let me know down in the comments below, do you believe we are about to see one of the biggest house market crashes in history? And are you waiting for prices to drop to buy a house? Let me know your thoughts down below. As always, thank you guys so much for watching. Until next time.